Let's take you straight to the top story that we're tracking this Thursday evening on India Tonight. It's a twin blow on the macroeconomic front. Inflation rose higher than expected in April, even as factory output showed hardly any growth in March, indicating that all is not well for the Indian economy. The index of industrial production rose 0.1% in March as compared to 1.9% growth in February, weighed down by a contraction in mining and manufacturing output. Experts say the latest data shows that while industrial activity is picking up, recovery remains volatile.
But it's the rise in retail inflation, especially the food prices, that's worrying the government and economists alike. Consumer inflation has edged up to nearly 5.4% in the month of April, a substantial jump from 4.8% in the previous month of March. The surge mainly attributable to the 34% jump in pulse prices. In fact, consumer inflation is much higher than RBI's comfort level of 5% for the current fiscal, making the prospects for a June rate cut virtually nil. The double whammy for the Indian economy is our top story right here on India Tonight.
It's a double blow for the economy. A slow growth in factory output, coupled with an uptick in inflation, is surely raising questions on India's pace of recovery. Factory output for the month of March has come in below street estimates at a meager 0.1% versus a growth of 2% the previous month. Weak manufacturing and a dismal showing in capital goods dragged growth. Manufacturing, that contributes nearly 75% to IIP, contracted 1.2% in March versus a growth of 2.7% the same time last year, while capital goods output contracted 15.4% in March versus a growth of 9.1% the same time last year. Mining sector output also contracted. Experts say weakness in the economy is worrisome and the order of take slowdown is beginning to hurt the capital goods sector.
The major areas of investments like fertilizer, cement, steel, power, oil and gas, none of them are, not a single project that is being spoken about in the market, at least for the past 6 to 9 months, nor am I expecting anything to be happening in the immediate future. So capital goods story is going to be negative.
Meanwhile, retail inflation has inched up, thanks to the rise in food inflation and pulse price inflation. CPI inflation for April has come in at 5.39% versus 4.83% in the month of March. Experts believe the central bank will take a note of the rise in retail inflation.
If you look at the results of the companies in the last 3 months, April to March, they have been very good. And I don't also, but at the same time there is not enough demand in the system. So that means most of the increase in the profit growth has been because of an increase in the operating margins. And there lies the explanation of why we are seeing a high gross value added, because most of the increase in the margins is because of the low input cost.
It's a double whammy for the economy. While the government claims revival, the numbers point in a different direction. And that is why experts believe the ball is now in the central bank's court. While growth is slowing, inflation is inching up. And that is why Governor Rajan could stay put in the next policy. Ruchi Bhatia, ET Now, New Delhi.
So let's take this straight across to our consulting editor Maithili Bhusnurmat, who's joining us right here on India Tonight this evening. Thank you very much for sparing time, Maithili. Is there a disconnect of sorts between the IIP numbers, just a growth of 0.1 of a percentage point, and the economic activity on the ground? I mean, government has spent so much, factory orders aren't looking up at all, manufacturing has shrunk by 1.2%. Is there perhaps a possible disconnect between the two?
Supriya, in response to your question, is there a disconnect between the IIP data that has come in at a dismal 0.1% and the actual economic activity in the ground? It's a little hard to say offhand, but clearly fourth quarter corporate results have been pretty good as compared to the previous quarters. So it does suggest that economic activity is stronger than what the IIP numbers would suggest. Part of the problem really is that IIP data is based on a base of 2004-05. The structure of the economy has undergone a huge change since then, whereas GDP data is based on 11-12. So there is this disconnect between GDP data that we are seeing, particularly now that we have shifted to gross value added, GVA calculations, as against IIP, which is volume driven. So I would not say that there's a complete disconnect, but certainly I would think that the IIP data does not reflect the revival that we are seeing on the ground. Certainly the IIP data would seem to suggest that the growth is not happening at all, whereas other data would seem to suggest that the economic revival is there on the cards, maybe slightly slower and maybe not as fast as we would like it to be, but certainly I would not draw too much of a conclusion from just 1 month's IIP data. So my broad conclusion would be, based on other data, it would seem that the economy is recovering, albeit slowly but surely.
But Maithili, in some ways, do these numbers defy the fact that India is the fastest growing economy in the world, which is what the government would like us to believe? But numbers on the ground clearly don't add up to that assessment, do they?
To your second question, do these IIP numbers really defy the view of India as among the fastest growing in the world? I would not really agree with that entirely again, for the simple reason that one must remember that the GDP data, the GVA data that we're talking, is based on the new methodology, the new base. So there is some bump up that we get because of the change of methodology. So I would still think that if you look at the way other economies in the world are growing, India would still remain the fastest growing. It would of course be nowhere near our potential, it's nowhere near our need itself. But having said that, I would still reiterate that India would still count among the fastest growing in the world, purely of course because the rest of the world is doing so poorly in comparison.
All right, so let's settle the debate once and all for as far as the one-eyed king comment in the land of blind is concerned. But what are the cues that you believe Finance Minister Jaitley and Governor Rajan should be taking from the two data points that have been reported, and we at ET Now believe they are a double whammy of sorts?
As to the cues that the Finance Minister and the RBI Governor would draw from this data, it is a little difficult to say, simply for the reason that 1 month's data, as we've seen even with US jobless claims data, high frequency data can seldom be relied upon for framing policy. So if I were the Finance Minister or the Reserve Bank of India Governor, fortunately I am not either of them, but if I were either one of them, I would say I would wait and watch and see what other corroboratory data I get, and only when other data, supporting data, also substantiates the case for a decline in economic activity or very slow pace of economic activity, then only would I act. For right now, if I was anybody in a policy making authority, I would prefer to wait and watch.
Stay in wait and watch mode. That's Maithili's take. Thanks for joining in as always with that perspective. Maithili Bushnurmat, our consulting editor, analysing that macro data.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.